Hello, everyone. Thank you for joining us tonight. Welcome to another edition of Real Estate Accredited, where we talk about all aspects about real estate, particularly multifamily, in-place multifamily, value add. And we're going to discuss in our series Unlock Wealth in 2024, we're going to discuss the role of market trends in investment decision making. My name is Philippe. I'm a co-founder of Boost Capital Group. We're helping busy professionals and leaders to invest passively particularly in multifamily. And we are hosting this weekly Real Estate Accredited call for educational purposes. As a company, we do not provide tax or legal advice. This material is for informational purposes only, and it's not construed as an investment advice or an offer or solicitation to buy or sell securities. Today, the role of market trends in investment decision making. So we're going to talk about a number of topics that I have listed here in the agenda: the demand and supply dynamics, which we discussed in the prior calls, prior meetings we had, rental rates and property values, trends, economic indicators, demographic trends, interest rates and financing, government policies and regulations, technological advancements, and market sentiment and investor confidence. All right, let's start. Demand and supply dynamics. So as we discussed in either the prior call or the one before that, we are spending a lot of efforts monitoring occupancy rates, and obviously high occupancy rates in a particular market, that it's going to show a strong demand for rental units. And in other words, it's a healthy market. Conversely, low occupancy could be the result of oversupply, is going to show declining demand and basically a market that you don't want to invest in. Sources you can use: CoStar, that we mention often, a lot of very interesting, very good information. RealPage do offer somewhat similar information to CoStar. There's also Yordi that you can use as a source, but CoStar is definitely the golden standard. Here, as an illustration of what the current trend is, for the reason that we mentioned, the oversupply. So you see the vertical darker gray bars that show new completions, and you can see that for 2024, there's a total in the US of 480,000 units that are expected to be delivered. So it's definitely, there's been a trend since 11 going up on the number of units being delivered on a yearly basis. And it's interesting because for a period of time, vacancy rates were still going down even though there was new supply. But more recently, this supply had an effect on vacancy rate, and there are multiple reasons that we also discussed in other discussions we had. I think the cost of housing is definitely being higher than what it used to be because of the inflation. That has an effect on the number of households being created. And even though there are new households being created, that's something we'll discuss a little bit later, the supply is such that creates just too many units coming to the market compared to the new households being formed. So as a result, currently there are higher vacancy rates overall. However, in the 5-6% on nationally, you can see that you're probably around the average over the period of time. Put it on the chart, which is from 2001. Next, new constructions that we just discussed, but definitely something that you want to monitor. And more specifically, you want to monitor that at the submarket level. And here I'm showing particularly a chart that was put together by Marcus and Milichap, showing more specifically the household formation compared to the inventory growth. And you can see that older markets are not impacted. Some are not impacted at all, like Las Vegas. Some are in line. And then you have more, the gap is bigger and bigger. And then you have the top markets with larger gaps from Denver, Phoenix, Charlotte, Salt Lake City, Austin, and Nashville. Those are markets that are going to be very impacted by new construction. And that's definitely something you want to check when you invest in a new market or such a market. And are you in a part of town where there is a lot of supply coming in? And if it's the case, then you're going to have a lot of competition. If at the same time you're not in part of the market where this supply is coming, then it's likely that you're not going to be impacted. For data sources, you can use the Dodge data and analytics, and also the local building permits data. Next, we have the rental rates and property values. Rental growth is something you want to check, and also you want to check that at the submarket level. I just brought a national chart here plotting the rent growth for single family and multifamily being in yellow, and you can see that there's been a consistent growth from 2016 to 2020, around 3%-ish for multifamily. Then there was a dip during COVID, then a huge increase up to 16% in March 2022. And there's been a correction. I think in some markets we've seen rents going sub-zero, rent decrease technically. Now we're back at a national level at 2.7%. Something also that you want to check at the submarket level. For sources, you can use Yarly Matrix, Zillow rental data, and apartmentlist.com. Property values, cap rates, something we also discussed quite a bit. Currently, cap rates have been expanding, which is linked to the interest rates being higher. And there is an expectation, as there is an expectation of interest rates getting lower, either at the end of this year or possibly in 2025. Then in this case, it's CoStar who's forecasting the local peak of cap rates which corresponds to a bottom of the local bottom of the market about mid 2025. But it could happen higher if the interest rates were going to get lower in the shorter term. Economic indicators, again, this is national information, but you will certainly want to check that at the local market, employment rates and creation of jobs, that's going to drive population growth on a particular market. So something to keep an eye on. Usually we focus more on directly on the population growth, but you can see that there is still a gap between the number of job openings and the number of unemployed people. As long as the openings are larger, the unemployment will stay low. But again, that's something, check at the local market level. For that, you can use the BS, the Bureau of Labor Statistics, and local economic development agencies. Another economic indicator, the income growth. Rising income can support higher rental rates. Obviously, if there is more jobs that are people to hire, that puts pressure on the salaries to get higher and for retaining employees. And here you can see from September, October. So September 2023 to March 2024, you can see in orange is the percent of change in income, and it was pretty high, 0.8 or 0.9%. Then it was lower. It's fluctuating a little bit, but more recently, the income growth has been higher. So you can see like the economy is global in America is pretty healthy. Demographic trends. We spend a lot of time talking about the population growth, very important factor in the past calls. But again, that's something you want to keep an eye on. This is the national numbers. You have different projections from the Census Bureau as well as CBO and SSA. And you can see that it is projected that the population is going to continue to grow in America, which is good. It's healthy for the economy. And so that part, in conjunction with local market population growth, that's something you want to keep an eye on and invest in the markets that have the most population growth. Also, you can find this at the Census Bureau and also Esri business analyst doing all kinds of analysis as well as provide real estate data. Demographic trends, we spoke about household formation with the constructions. So you want to make sure that the household formation in the particular market is in line with the construction. So it goes with the new constructions. Here for data, there's the NAR, the National Association of Realtors, as well as the Pew Research Center. I would say CoStar also a very good source. Interest rates. So you want to keep an eye on interest rates and understand how they're going to evolve. A couple of years back, or even a little more than that, but in 2022, the Fed started to increase, or at the end of 2022, the Fed started to increase interest rates, and it put a lot of pressure on prices went up. That's many years from now, many years. So let me carry on. So interest rates went up in end of 2022, 2023, and now they didn't change that much, but there is an expectation that the interest rates will go down. When interest rates will go down, it will release the pressure on prices, and therefore cap rates will go up. I just put a chart here of the mortgage rates, which I know for multifamily commercial real estate, it's not exactly the same, but it gives a good indication of what to expect. We're expecting rates to go down last quarter of 2023. So you have Fannie Mae and projection Wells Fargo as well as the Mortgage Banker Association. So obviously that didn't happen. Now we are Q2 of 2024 and that still didn't happen. But it's supposed to go maybe at the end of the year. So we have to get the data. The Federal Reserve economic data is a source for obviously interest rates or bankrate.com as well. Let's move on. Interest rates and financing. So availability of capital. So that's also a very important factor. Like, are investors ready to invest? Which part of it is market or consumer sentiment, but also, let's say you have consumer sentiment on one hand for more the retail market, but then you have at the institutional level, it's more or less the same. Are people ready to deploy funds, and do they have a positive outlook? So you can see that since mid-2022, I guess, when the interest rates started to go up, the amount of capital, which is the private equity valuations in that case, was divided by 2. Then it remains stable, but it's a slow growth back. That's to find good data on this, quite frankly. Yeah, mentioning commercial mortgage alert and the REIT reports, not something that we necessarily spend a lot of time on because we are more interested by the capital being deployed by investors. And from that standpoint, the market sentiment, which is the next slide actually, investor sentiment, is more important. So there's a university that is running a poll on a regular basis on what's the sentiment, and you can see that actually at the end of or mid 2020 it was reached a bottom, which is when the inflation was super high and everybody was talking about a recession and whatnot. But since then, it has improved. I guess you can see a little bit of a cyclical period, but it's been pretty good. We're back at the level post-COVID right now.
Oh,
Hopefully,
yeah.
we'll go back to these levels right there.
It's a little bit lower
I think that's a good sign because I think at the end of the day, the consumer, it's driving the economy a lot, right? What people are buying and so on. So for sources, which that's probably not correct because I don't see why national multifamily housing. I would say like just search for consumer sentiment online. You'll find it. I'm just going to remove this. This is not correct. All right, next, market cycles. Market cycles. So that's also that. So that's interesting to know. It's I think when you put everything else together, gives you a good idea. But there is particularly the Pricewater Real Estate Outlook report where you can find they publish these little wheels. So it's very interesting to see which markets are at which phase of the cycle, going from bottoming to recovery, growing, mature, plateauing, slowing, and falling. And it's a cycle that repeats itself. So you can see right now, at least this firm, John Burns Research, they say that Denver, Nashville, and San Jose bottoming. Falling, you have Austin, Minneapolis, Salt Lake, Provo, San Antonio, and San Francisco. And then the other markets, they're in recovering or slash mature. So that would be probably the markets that certainly you want to invest in recovering or growing mature markets. And you want to avoid the slowing, falling, bottoming. You don't want to be early necessarily. So as long as if you buy here and it stays, maybe it may plateau in some time, but and it may not. Like every market is different. Because again, I think if you look Dallas, Charlotte, Atlanta, I'm not sure about Boston, but Houston, all these markets, I'm sure, yeah, there's Miami, Orlando, Tampa. There are a lot of markets there that there's a lot of population growth. So even though they may be considered mature, because of the population growth, there's still room to until the trend is going to change. So next, I'm going to have a couple of slides left. Just go quickly through those. What you want to monitor as well is technological advancements, such as smart home technologies. That those are things that you see being spread out like throughout. I would say Class A for sure, Class B, it's coming up. Smart home being, it could be from the thermostat to the door lock to smart switches, and now you can control everything online. So it's always a plus for, I think, a tenant to have a technology package like that. You can have the sensors for leaks and all these things. So it's a lot of good features available. Also, from a technology standpoint, property management software that are improving, and there are a lot of AI bots for leasing, for instance, that are available. I think the system is called Elise, and allows you to have 24/7 some virtual AI system that will pick up the phone and answer the basic questions of tenants. So those are things where I think that there will be opportunities, something to stay aware of, definitely. And finally, the government policies and regulations. We always want to keep an eye on zoning laws that may change, can affect supply of what can be built. Usually, and that's something that's really market by market. You have to something to consider, especially if you're buying an asset and you think that there's no more supply coming in the market, and all suddenly zoning is being changed, and now you have new construction across the street. Last bullet point here, tax incentives. So usually it would be more local at the county or city level, that you may have some opportunities to work with the local government to obtain tax credits or incentives because you're bringing business in a particular area. I know there are some programs in Tennessee and Texas particularly. So that's all I have for the trends to keep an eye on. Definitely that there was a lot of information, but just stay aware, follow some market news and stay updated. And all these things will be discussed and mentioned, and you can do some research on your own. Especially what's important is to do very localized research on any market that you're considering. So again, my name is Philippe Schlegan. You can reach me at philippe@boostmycapital.com or scan the QR code to access my bio page on our website. Same thing for my partners, Jeff and Chris. And if you have not done so yet, subscribe to our YouTube channel. You can reach it at youtube.com/@boostmycapital. Thank you for joining us, and we will see you soon. Bye bye.